In this lesson, we'll discuss how to forecast the remaining balance sheet items: PP&E, financial liabilities, equity, and cash. And once we've done that, we would have forecasted all financials necessary for a complete three-statement financial model. Sounds good, right? Let's get started then. Property, plant, and equipment is a group of assets typically used in production or administration. If a firm owns a production plant, its value will be shown in the PP&E account. Cars used for administrative and selling purposes will be shown here as well. Every year, the value of these assets is reduced through depreciation, an account showing the assets are older and their market price has decreased. However, most firms invest in new PP&E assets every year. This spending is called capital expenditures, or simply CapEx. These are new assets added to the PP&E account. Therefore, when calculating PP&E, we need to remember the firm starts with a certain level of PP&E. And then, when these assets are used throughout the year, their value is reduced through D&A. So, this leaves us with a lower PP&E. But if the company invests in CapEx, the PP&E increases. These items should be considered when modeling PP&E. Some modelers prefer creating detailed D&A schedules for different assets, according to their useful life. Others simply model CapEx as a percentage of revenues and D&A as a percentage of beginning PP&E. Both approaches are solid and defensible, and you can use the one corresponding to the level of information you have and on the amount of forecasting precision you would like to obtain. Right. This is PP&E. Modeling financial liabilities can be simple for some companies and a rather complex task for others. It all depends on the number of loan facilities a company has used, on the complexity of these facilities, and on the number of contractual covenants agreed with lenders. Let's consider how a debt schedule functions. Similar to what we saw for CapEx, we have 4 items: beginning debt, new debt, debt repayment, and ending debt. To calculate debt repayment, we need to go through the firm's debt facilities and calculate the amounts paid to lenders. Then, once we've done that, we have to distinguish between interest expenses and debt repayment. If we don't have sufficient information to do this detailed breakdown, we can calculate historical cost of debt by dividing interest expenses by financial liabilities, and then use the historical cost of debt for the forecast period. The equity schedule of a company is influenced by the following movements: beginning equity, increases of capital by shareholders, shareholders providing fresh funds to the company, the net income or loss produced throughout a financial period, and dividends payments to shareholders. This gives us ending equity. The third component is one of the most important links between the income statement and the balance sheet. I'm sure at this point you understand that if we don't build the model correctly, respecting a certain logic, it won't balance. Okay, how are these lines forecasted? Beginning equity is given by the ending equity of the previous period. It is very rare to forecast an increase of capital. Forecast it as 0. Okay? Net income has been calculated in the P&L. Therefore, we can link it there. And finally, we have dividends. Most modelers look at the historical dividend payout ratio of the firm and model dividends as a percentage of the cash flow produced by the firm. Perfect. This gives us ending equity. The last account that must be forecasted is cash. To forecast cash, we need to build a cash flow statement. And then cash will be equal to beginning cash plus net cash flow observed throughout the year. This is how we can build a complete model. Once you are ready, open the balance sheet and check if assets are equal to liabilities and equity. If that's the case, you've worked correctly.